I guess there's three things. One is the fundamentals are still there. The second thing is the reasons people have been buying gold still remain intact. That certainly hasn't changed. And the third thing I would say is that there is...
You're watching Silver News Daily. Subscribe for more.
The recent silver crash wasn't a warning sign. It was the final fake-out before the biggest breakout in decades. Central banks are scrambling, the dollar is collapsing, and yet somehow the public still isn't paying attention. But if you look closer, this exact setup already happened once before, and it triggered one of the most violent bull markets in financial history. In the early 1970s, gold dropped hard, right before it exploded tenfold. Now silver's doing the same thing. After hitting a 12-year high in October, prices suddenly plunged. Mainstream analysts say the run is over. But behind the scenes, something far more explosive is building. Central banks are dumping dollars at record speed. Silver is still wildly undervalued. And investor positioning? Completely asleep. This is the kind of setup that only comes once in a generation. And when silver starts moving, it moves fast. So the question is, was this crash the end of the rally or the beginning of something far bigger? Let's find out.
Just looked at gold going from 3,300 in August to over 4,000 today. You would be delighted, right? If you'd been away on a vacation somewhere for the last 2 weeks and didn't know it had got even higher. So, I mean, I think if we look in this in context, yes, this is absolutely, the last 2 days we've had absolutely very sharp declines. But if we look at it in context, I'll say a few things. First of all, you said, we're only back to where we were less than 2 weeks ago, less than 2 weeks. Second point I would make is that even this dramatic decline for the last 2 days, as dramatic as it is less than 20%, no, less than 30% of the rally from September. So, and given that that rally, as you said, was so extraordinarily sharp, when you have a pullback, you expect a pullback, frankly, of as much as 50 or even 60% of the rally as a retracement. So we haven't seen that yet. And if you look back, whether it's 2020 with COVID or 2011, obviously, 2011, 2009, 2006, we've had declines similar to this in the past. This is not, I've heard people say unprecedented. This is not unprecedented at all. And that's before you even go back to 1974. So I guess what I'm trying to say is just to put a bit of context on it. We had that very, very dramatic move from the end of August until, Monday. It was unclear how long it was going to go. And my take is that nothing fundamental has changed. I think the move was certainly overdone, and I use the expression several times, overbought, but are still underowned. There's no question it was overbought, and there was nothing fundamental yesterday that set off this decline. That's important for people to realize. It wasn't that central banks suddenly said, we don't need to diversify away from the dollar anymore. It wasn't that, we've got both in Gaza, the peace is looking a little bit fragile, but particularly in Ukraine with no meeting between Trump and Putin. If anything, the news was gold bullish. There was nothing that caused this other than just the market dynamic, that it had moved too far, too fast, and there were people looking to take profits and buyers saying, well, let's just wait a little bit. So that's my take. And so long term, I think, or long term, medium term even, the drivers of gold for the last 3 years, the people buying gold and the reasons they were buying.
Silver's recent pullback has all the hallmarks of a classic bull market trap, the kind that shakes out the weak hands just before prices rip higher. From October 15th to the 20th, silver surged to $37.40, its highest level in 12 years. But within a week, that gain was wiped out by a sharp correction, bringing the price back down to $32.85. Panic followed. Headlines warned of a reversal. But look deeper, and the story changes entirely. This wasn't a collapse. It was a textbook technical reset. Silver had just posted a 28% rally in under 6 weeks. The RSI was screaming overbought. Traders were overloaded with long positions. And then came a 12% pullback, almost exactly half the rally, right in line with Fibonacci retracement norms. This isn't unprecedented. Similar pullbacks happened in March and July of this year, and both times, the bull trend resumed stronger than before. The 50-day moving average at $31.20 is holding firm as support. RSI is now neutral at 52, no longer overheated. Speculators have already trimmed 15% of their net long positions on COMEX, clearing the deck for another leg up. This is how bull markets breathe. They run, they cool, and they shake out the tourists. The fundamentals haven't changed. In fact, they've only strengthened. And just like in 1978 or 2010, every fake-out brings us one step closer to a vertical move.
Market is increasing even as I see the possibility for the market to continue to go up. And that is not contradictory at all. I mean, you can have a lot of risk that doesn't what's the expression? What would I say? Doesn't come to fruition. And I'll never forget my friend Bill Barner, gave a wonderful analogy of the guy that's at the party, gets absolutely stone drunk. It's 1 o'clock in the morning. He gets into a car. He speeds home at 80 miles an hour on 30-mile-an-hour speed limit streets, and finally stumbles into bed. Well, the fact that he arrived in bed safely does not mean there was not any risk. And it's the same that I see with the stock market right now. So number one, it is overvalued on any fundamental basis, and I don't know how anyone can dispute that. Number two, the breadth has become even more narrow than it was. At the end of last year, it was an all-time record, the narrow breadth, meaning there's only a handful of stocks that lead in the market, and it's got even narrower over the last 10 months. So the breadth is really narrow. There's a lot of different indicators that market technicians use, the Hindenburg omens or whatever, and so on. And I'm not going to get into all of those, but all of these indicators are flashing red. And perhaps the most important one would be this ratio of insider sales to purchases. Now, there's a lot of reasons that insiders might want to sell, a lot of reasons. There's only one reason that you buy in the market, unless you're trying to pump up your stock price. There's only one reason you buy in the market, and that is that you like it. And when the ratio of insider sales to buys is so overwhelmingly on the sell side, a multi-decade high, all of those four are indicators that the market is stretched and the next major move will be down. But none of what I've said will tell you when it's going to happen. Certainly doesn't tell you it's going to happen tomorrow morning. But from an investment point of view, I think what it does tell you is that there is increasing risk in the market. And so we're just being very, very cautious with what we buy. We're buying defensive stocks, which will tend to go down less than the rest of the market.
Now here's where things start getting undeniable. The technical picture for silver isn't just intact. It's setting up for a major upside breakout. First, let's talk support. Silver's 50-day moving average, sitting at $31.20, held like a rock during the correction. That's not just coincidence. That's institutional-level defense. And it matters, because in bull markets, that moving average often acts like a launch pad. Then there's the RSI, now hovering at 52. This tells us the market has completely reset its momentum from the overbought readings above 70 in October. In other words, the rocket has refueled. But what really drives this point home is the retracement pattern. From the October high of $37.40 to the recent low, silver gave back just about 50% of its previous rally. That's not a breakdown. That's the golden ratio. And it's a classic sign of consolidation before continuation. Look back at previous silver bull runs, and you'll see the same script. A spike, a sharp pullback, momentum cools, positions reset, and then blast off. Analysts at Metals Focus are now calling for $40 by the fourth quarter next year. The CPM Group expects $36 as an average. And even the bear case from UBS sees only limited downside. Why? Because technically the path of least resistance is up. As long as silver holds above the 50-day and maintains neutral momentum, the next move is likely to retest the October highs, and from there, it could get disorderly. The market is primed, the traders are cautious, but the chart is bullish.
That manic public participation before you can have a top. And, we know the gold in particular, but also silver. Gold and silver are very difficult to they're difficult to come up with what is the fundamental value because, with a company that makes widgets, you look at their sales revenue and you look at their price to sales and their price to earnings, and you look at whether their costs are going up, and you look at the dividend it pays. When you look at gold, well, it doesn't pay a dividend, as we know. The detractors keep telling us it doesn't earn anything. Okay. So what do you value it on? So you can value it on, the price of gold today, inflation adjusted compared with previous highs. That's one metric, but I don't think it's a be all and end all. Apart from anything else, the CPI is a very, very unsatisfactory metric to use. Now, if we went back to 1980 and used the methodology that they were using back in 1980 and used that the whole way through, well, you'd find gold is still not particularly expensive. It's more or less the same. It's more or less just kept pace with inflation over that period. You can look at gold versus the money supply, U.S. money supply, global money supply, U.S. versus debt. Gold versus debt. All of these are sort of metrics you can use that give you a gauge. No one is perfect. As with a widget manufacturer, you can say, well, I'm looking at the price to earnings, right? But you can't do that with gold. But all of these metrics, and then other people will look, and one of my favorites, frankly, is the gold to Dow. So gold versus financial assets. And that one is very, very telling. Certainly we're off the bottom. No question about that. And we're perhaps meaningfully off the bottom, but we are so far from those lows, that is gold, the Dow being at a low to gold, or highs, I should say, gold high relative to the Dow. We are so far from those points that we've seen in the past and have typically indicated a fundamental top for gold and a long-term decline. We're nowhere near that. We're still closer to the bottom than we are to the top. So on all those metrics, I think we can argue different ones will give us something different, but not one of them is saying that gold is over.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
Despite silver's impressive run this year, it's still shockingly cheap, both in nominal and inflation-adjusted terms. Let's start with the surface numbers. The recent high of $37.40 might feel like a win, but it's still a far cry from the 2011 peak of $49.50. Adjust that 2011 high for inflation using today's CPI, and you get around $72 per ounce. Use the 1980 methodology, and the number explodes to over $190. Now stack that next to silver's current price of $32.85, and you start to see the scale of the gap. We're not near the top. We're still deep in the discount zone. But the story gets even more ridiculous when you look at physical premiums. In October, premiums on Silver Eagles were up 15%. For generic rounds, premiums surged 20% month over month in September. That's not happening because silver's overvalued. That's happening because people are waking up. Physical demand is heating up even while the spot price stays suppressed. And it's not just retail buyers. Industrial users are locking in long-term contracts now, seizing what they know is a rare opportunity. In short, the world is quietly accumulating silver at prices that are decades behind reality. Analysts like Adrian call the current market remarkably undervalued. HSBC projects silver hitting $85 by 2028. Some models show fair value right now between $65 and $70 per ounce, double today's price, and that's without public mania. And here's the kicker. Silver is up 38% year to date, while the CPI is only up 3.2%. So even after one of its best years in a decade, silver is still losing to inflation-adjusted benchmarks. That's not a sign of a bubble. That's a flashing green light for what's still to come.
That certainly hasn't changed. And the third thing I would say is that there is no mania. I don't know how it is for you, and you can say if you want or not say if you want, but some of the coin dealers I talk to will tell me that up until the last week, even if they've been busy, it's been as many people calling to sell gold and silver as it is to buy gold and silver. When you look at most mutual funds, and I'm not talking about our mutual fund now, and we're not allowed to give out information before it's been publicly released. I'm not talking about ours, but I can tell you that most gold mutual funds, and I'm talking now obviously about equities, but most gold mutual funds have been seeing ongoing outflows. For GDX, which is the minor ETF, if you look at the last month, it's had a small inflow, net inflow. But, for the last 2 months, 3 months, 4 months, it's been outflows. And the point I'm making is that there is no broad public participation in this market. And you cannot have a top. It's impossible to have a top in a market, by definition almost, without public participation. 1980, you certainly had public participation. You will remember, even though you weren't alive, you've seen the pictures, I'm sure, of people lining up at coin dealers, lining up around the block to buy gold. We haven't had that this time. So no mania, very, very little in the way of public participation. And so I just...
One of the clearest signs that silver is being massively mispriced lies in the gold-silver ratio, and right now, it's screaming for a reversion. As of November 3rd, the ratio sits at 82 to 1. That means it takes 82 ounces of silver to equal the value of 1 ounce of gold. Historically, that's a level reserved for extreme dislocations. In past bull markets, this ratio didn't just shrink, it collapsed. In 2011, it dropped to 31 to 1. In 1980, it fell as low as 15 to 1. Each time, silver didn't just catch up to gold, it exploded past expectations. The current ratio is down from a peak of 98 to 1 in March, and it did compress to 78 to 1 in October before widening again with the recent pullback. But this back and forth is all part of the setup. When the ratio is this high, institutions start arbitraging the gap, dumping gold and rotating into silver. That's not theory. We're already seeing it reflected in mining equities. The SILJ ETF, which tracks junior silver miners, is up 45% year to date. Compare that to GDX, the gold miner ETF, which is up 28%. That's a 17% outperformance. And it's just the beginning. If the ratio merely compresses to 60 to 1, silver would need to rise another 36%, even if gold stayed flat. And if it revisits the historic lows of 30 to 1, we're talking about an explosive surge that could push silver to triple digits. Sprott Asset Management is already projecting 50 to 1 by 2027. Meanwhile, even cautious analysts admit that silver's lag has created the potential for outsized moves. As Adrian Day recently put it, the ratio may not be as predictive as it once was, but it still confirms silver is behind. And when silver lags, it eventually leaps.
In gold, nothing has changed. And I'll just say, for example, central banks, which have obviously been the most important buyer for the last 3 years, particularly particularly 23, 24, and the beginning of this year, they've been almost holding gold up alone. If you look at the central banks, they're diversifying away from concentration in a single asset, an asset of a country that is fiscally irresponsible, and added to that a country that is using its dominance, it's weaponizing its dominance, both with the dollar and with the SWIFT system. And this has been going on a while, and that's the point that I would want to estimate, both the weaponization of the dollar and also the central bank's diversification away from the dollar has been going on for a while. If you go back to 1999, the beginning of this century, in aggregate, central banks had 78% of their foreign reserves in the dollar, 78%. And by foreign reserves, we mean for the Bank of England, not the British pound, for the Bank of Japan, not the yen. So foreign reserves, 78% were in the dollar. 5 years ago, that was down to about 65%. Last year, according to the IMF, it ended the year at 58%. And in August, the ECB said it was 48%. And so this has been going on a long time. And what I would say is that the drivers, nothing has changed. I'm not going to get political, but I would say even if this administration didn't start the onslaught, they've done nothing to change it or to stop it. And if you're a central bank worried about concentration of a single asset from a fiscally irresponsible government which might weaponize its dominance, well, I ask the question, is 48% still too much? And I would say 48% is still too much. So we're going to get continued reduction in the dollar. And remember, these countries are continuing to earn dollars all the time. So we're going to get continued reduction in the percent in the dollar. And where is that going to go? Some will go to the euro. The euro is at about 22% of central bank's foreign reserves. For the aggressive ones, some will go to the yen, or some might go even to the Australian dollar or something. But this is at the margin. Most of those assets, other than the euro, most of those assets are going to go to gold. And that's going to continue, in my view. That was a long answer, I'm sorry, but I just wanted to sort of set the...
While the technicals and ratios paint a bullish picture, the real fuel behind silver's coming explosion is something far deeper. A growing structural supply crisis that the market can't ignore much longer. In 2025 alone, we're looking at a projected deficit of 215 million ounces. That's the second largest shortfall ever recorded. And it's not a temporary blip. It's the continuation of a multi-year trend that shows no signs of reversing. Silver mine production has flatlined at 830 million ounces, despite growing demand across the board. Recycling is up 4%, but that's barely scratching the surface. And industrial consumption? It just keeps climbing. Fabrication demand now makes up 57% of total silver usage, compared to 45% a decade ago. Solar, EVs, electronics, AI infrastructure, it's all demanding more silver every single year. And the supply just isn't there. What happens when supply can't keep up? Inventories get drained. COMEX alone is down 28 million ounces year to date. That's not retail panic. That's the professionals quietly pulling bars out of the system. And every time silver re-enters a deficit cycle like this, the floor gets higher. In 2024, the low was $22.50. In 2025, it's already risen to $26.50. This rising floor effect shows the underlying price strength, even through the volatility. And let's not forget the geopolitical risk. Strikes in Peru have cut 12 million ounces of annual output. Mexico's grades are declining. New mines aren't coming online fast enough. According to the CRU group, it would take a price above $40 to even begin incentivizing new production. That's the baseline, not the top. Until we hit that threshold, deficits will continue, and silver's price will be forced higher simply out of necessity. So while investors debate charts and ratios, the real battle is playing out underneath the surface, in the cold, hard data of supply and demand. And right now, supply is losing.
Things will affect them. So the big question with copper to me is the global economy, and particularly the Chinese economy. China is still the largest consumer of copper, largest importer of copper. And so we have to watch the Chinese economy. If that slows, and there's mixed signals at the moment, the growth seems to be continuing okay, but it's moving towards a deflationary environment. Now, as you know, you can have growth and deflation. In fact, that's the ideal situation, right? To have economic growth and deflation at the same time. But more often than not, deflation might indicate weakness ahead. So that's something we have to watch. But other than that, even if the electric vehicles, which use more copper than internal combustion engines, of course, but even if, the demand for EV slows down, even if electrification goes slower than we expect, you make the most conservative assumptions on all of the different demand equations, these data centers and so on and so forth. Make conservative assumptions. And we still don't have enough copper from current production or from current projected production. We still don't have enough production to meet those demands. So, within 5 or 10 years, that's going to be resolved with higher prices, of course. Could be a new technology, but more likely than...
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
Sure, whatever I buy, I would make sure they have a strong enough balance sheet that they can withstand another 6 or 12 months of current prices. Copper is another one, that's very cheap. Copper is very cheap relative to gold. And the copper story itself is a very strong one. We're simply not finding enough large copper mines. Large copper mines. That is something that's going to be in the top 20 global production. They're very, very rare, obviously, and if you look at even the top 10, you look at the top 10 copper producers right now, something like, 7 of them were pre-1960, and 5 of them were 19th century, started in the 19th century. We have very, very few large, really large copper mines come on. We've got a temporary problem at the moment, with Cobre Panama, which was about 2% of global production, shut down by the Panamanian government. You've got Grasberg, which is one of the top copper mines in the world, number 4, I think. That's closed down temporarily because of the accident they had there. And then you've also got temporary shutdowns or reductions at 2 other, top 10 mines. So right now there's a particular squeeze. But I guess the point I would make is that things like that are not rare, unfortunately, in the copper business. Copper mines are huge. As I say, they're old, which means they're very, very deep. And so mines, I remember 10 years ago when a mine in Chile had to close down temporarily because of an earthquake 200 miles away. But because they're so deep,
If the supply crisis is the floor under silver, industrial demand is the rocket fuel. And this isn't some slow-burning trend. It's accelerating faster than anyone predicted. In 2025, industrial offtake accounts for a staggering 57% of total silver demand. That's more than half the market, and it's only growing. The biggest driver? Solar. The solar industry alone is expected to consume 230 million ounces this year, up 18% year over year. By 2030, Bloomberg NEF projects that number could hit 400 million. Why? Because silver isn't optional in solar panels, it's essential. No other metal matches its conductivity or reliability in photovoltaic cells, especially as efficiency standards rise. Governments around the world are throwing billions at renewable infrastructure, and silver is at the heart of it. But solar is just one piece. Electric vehicles are ramping up globally, and each one requires 25 to 50 grams of silver. With EV sales in China alone up 42% in September, that demand is surging. Add in hybrids, and we're looking at 85 million ounces going into vehicles this year, up 20%. And then there's the AI boom. Data centers and high-performance GPUs now require significantly more silver than older tech. NVIDIA's latest GPUs use 15% more silver per unit compared to 2023. AI infrastructure is projected to add another 50 million ounces of demand by 2028. And here's where it gets interesting. Industrial users can't just stop buying when prices go up. These are non-cancelable contracts. Production lines don't halt because silver is $40 instead of $30. In fact, price dips often trigger more forward buying as companies try to lock in costs ahead of anticipated price spikes. This ratchet effect means every dollar increase in silver isn't just tolerated, it's absorbed. Unlike investment demand, which is emotional and volatile, industrial demand is steady, aggressive, and completely inelastic until prices hit extreme levels, which they haven't yet. But when they do, the price ceiling will be determined not by traders, but by industries desperate to keep their supply chains alive.
growth is peaking, has peaked, and what else is going to replace it in the near term, we don't know. So that's number one. And the number two thing, of course, is just this whole green narrative that's taken place in the last 10 years, where people, even if you were not opposed on principle to oil and gas, and as you know, a lot of funds in Europe in particular were just refused to invest in oil and gas. But even if you weren't of that camp, you could see the writing on the wall with all these no more internal combustion cars by 2030, no more oil by 2040. Absolutely, totally unrealistic targets. And now, as you know, different countries are beginning to back away from some of those targets. But I do think that had a huge impact. It had a huge impact on the capital investment that the oil and gas companies made. And it had a huge impact on investor sentiment towards that sector. The sentiment towards oil and gas is weaker than anything else other than coal. I'm not sure there's anything else with a weaker sentiment. You look at the S&P, for example, 15 years ago, 20 years ago, oil and gas was 18, 20, 22% different years of the S&P. Right now it's less than 2%. It is such an out of favor sector. And if you look at, I gave a talk recently where I was saying to people, we may see a correction in gold, but this is not the top. I think gold and gold stocks have a lot further to go, but other things are even cheaper. Oil and gas relative to gold is at, I saw a table, I saw a table, and oil and gas relative to gold is at an unprecedented extreme. It's never been that cheap relative to gold. So I think for those reasons, because people are realizing that the shales have peaked, and even if they don't realize it, they have peaked, which means that the production's not going to go up, and the sentiment is shifting away from this. Well, we'll have no more oil and gas, in 15 years' time. So I think we're going to see oil and gas make a bit of a comeback. And there are some good companies. The only thing I would say is I would make...
Now let's connect the final dots. Because while silver's supply crunch and industrial surge are powerful on their own, what's really going to light the fuse is what's happening to the dollar. Behind the scenes, a silent revolution is underway. Central banks are bailing on U.S. treasuries and quietly hoarding gold at a record pace. In just the first half of 2025, they bought 480 tons. That puts them on track for nearly 900 tons by year-end. And here's the twist. Every time central banks load up on gold, silver follows. Why? Because silver has a 0.85 correlation to gold. When gold runs, silver doesn't walk, it sprints. The difference is gold moves first because it's the reserve asset. But when investors realize silver is the leveraged play on the same macro trend, it unleashes a wave of catch-up buying that historically outpaces gold's returns by multiples. But it's not just about gold anymore. The dollar is crumbling. IMF data shows global reserves held in dollars have dropped to 48%, down from 58% in 2023. Countries like China and India are dumping dollars and boosting precious metal reserves instead. The People's Bank of China added 15 tons of gold in September. India's central bank added 8 tons in Q3. This isn't random, it's coordinated de-dollarization. And while central banks don't officially hold silver, their moves shift sentiment across the entire precious metals complex. As trust in fiat evaporates, investors aren't just turning to gold, they're also turning to silver, especially as gold becomes scarce and expensive. The arbitrage opportunity becomes irresistible. Swapping overvalued gold for undervalued silver becomes not just logical, but essential. This pressure is already being felt. Gold's strength is anchoring the entire metals market. With COMEX supply tightening and central bank flows draining available metal from the system, silver is about to ride the same wave. Only harder, faster, and with far more upside. Because in a world where paper money burns, silver isn't just a commodity. It's monetary rebellion.
That huge increase in production from the U.S. shales. And the U.S. shales actually have contributed about 90% of the global growth in oil over that period. Now, I'll say it again because I don't want people to say, misunderstand what I said. I'm not saying they represented 90% of production. I'm saying 90% of the global growth in production came from the shales. And they've just been a phenomenal, the huge increases in oil and gas from the shales has been fabulous. But as always, we extrapolate things way into the future. And people miss that the shales, most of the big shale fields have now peaked. And the remaining ones will probably peak, if not this year, next year. So we're not going to continue to see growth from the shales. Now, how long are those tails? I won't go into it because I'm not a whatever they call them, geophysicist or something. I won't go into all the details. There are reasons to think that the tails on shale are a lot shorter than the tails on traditional fields. But either way, they peaked. No one can deny that. And so we're not going to continue to see growth from the shales. That's number one. Number two, and what are the new fields that are going to replace it? That's another big question. What are the new fields that are going to replace it? And I'm not sure what they are right now. There is some offshore success, offshore Venezuela and Guyana, in that northern bit of South America, which might partly be the reason for President Trump getting interested in the narco boats down there. So that's a potential, but, the Brazilian offshore fields, the North Sea, all of these things, Mexico, we can't expect to give us another big boost in production. So the shale, which is 90% of
So here we are. After months of relentless buying by central banks, a collapsing dollar, a tightening supply chain, and industrial demand going vertical, silver is sitting on the launch pad. And the target? It's not $50. It's not even $100. The real insiders are pointing to $500. Sound crazy? So did $50 in 2010. So did gold at $2,000. But look at the setup. Inflation-adjusted highs above $190, gold-silver ratio still at 82:1, structural deficits projected to persist for years, and public interest still near zero. The market hasn't gone parabolic yet because the public hasn't arrived. But when they do, when the headlines hit, when silver breaks $40, $50, and momentum traders flood in, the repricing won't be gradual. It'll be violent. By the time the average investor hears the words silver breakout, it'll already be too late. This is the final warning. The $500 price target isn't hype. It's math. It's momentum. It's monetary physics playing out in real time. The only thing missing is you. So if you want to stay ahead of the reset and understand the full story behind the coming silver explosion, make sure to subscribe. And remember, this is not financial advice. Always speak to a licensed professional before making any investment decisions.
dividend-paying stocks, which will give you a dividend even if the stock price declines. And mostly, frankly, we're just holding cash. We're just holding cash instead of buying stocks. And now we're also buying global stocks, I should say that. But in terms of the U.S. market, I think it's just a time to be really cautious. And again, things will change probably just as suddenly, just as much without warning as they did in the gold market. They say famously they don't ring the bell at the top. One day, after 5 up days, we're suddenly going to turn on the Bloomberg and the market will be down. And there may not even be a fundamental reason for it. It's just that you finally exhaust buyers. And the market stops going up. The thing about the stock market, particularly in the US, of course, is really important to understand, is that most of the money flowing into the US stock market comes from 401ks, so it's regular contributions. And so long as employment is still relatively strong and people are still employed, that money will still go into 401ks, and most of the 401k money, in my experience, will go into the US stock market. I mean, every year I get my clients will send me, it's that time of year again, Adrian, I've got to decide where my 401 contributions are going for the year ahead. And, they've given me 5 choices. Well, it's US big cap and US small cap. There's probably a global fund in there somewhere. There's a bond fund or a treasury fund. And that might be it. There's no gold fund. There's no resource fund. There's no long short hedge strategy. There's no emerging market fund or anything. And so my clients who, my clients who are educated on gold and like gold, they will say, well, I guess you're taking care of gold and you've got a lot in the foreign markets. I may as well just stick it in the S&P. And so I'm sure that is true for an awful lot of people around the country. Just keep it in the S&P. And so long as employment continues to be relatively strong, and I personally think it's the employment picture in the U.S. is much, much weaker than the headlines would suggest. But, so long as we don't have, broad layoffs and unemployment, I think that money is going to continue to flow. But again, like the drunk who finally gets into bed, doesn't mean that there's no risk. I heard a wonderful metaphor the other day. Somebody said, I know some of you want to continue dancing, well, until the party ends. Well, make sure you're dancing very close to the door.